Welcome to this Killick Explains video, and this time I want to talk about 3 ways investors should exploit the power of time. Now, there are very few free lunches in investing, there are very few free lunches in life in general, but one of them is time. And unfortunately, by definition, we have less and less and less of it as we go through life, but taking advantage of it is critical when it comes to successful investing. So this is going to be all about how can we do that. And I'm going to say there are 3 possible answers here, and we'll go through them one in turn. 1, maximize the power of compound growth. More about that in a moment, I've talked about it before. 2, make sure you're reinvesting dividend income wherever possible. And number 3, despite the volatility we're seeing at the moment, despite the geopolitical risk floating around at the moment, stay in the race. Now, maximizing compounding. This is all about starting early. Now, for anyone watching this video thinking, well, I didn't start investing 25 years ago, Tim, it's too late. No, it's never too late, but the sooner, the better. Doing something beats doing nothing, no matter what stage of life you're starting investing at. And basically, the reason is the power of compound returns, the ability to make money on money. And just to illustrate that, I'll reference my guide at the end that's got lots more other examples in it, but let's take an investment of £100 per month starting now. Let's say you've got the benefit of a reasonably long time horizon and you could earn 3%, 5% or 10%. Now you have no idea up front what you might earn. If you're doing it through a bank account, those rates are reasonably certain. If you're doing it through some sort of equity-backed product, your capital's at risk. There is less short-term certainty. But let's make some assumptions, purely mathematical ones. 3%, 5%, 10%, £100 per month. Where would you be if you had the luxury of a 25-year runway where you're constantly investing £100 a month? Now, the answers I'm about to give come from the calculatorsite.org. I have to give my sources in these videos. So after 25 years at 3%, which is relatively conservative, I mean, you can do a lot better than that in a bank account at the moment, you'd have around £45,000, having invested £100 a month. At 5%, £60,000, and at 10%, if you could achieve that, £134,000, of which £104,000 is interest. Now, I'm not going to call that free money, but that is basically the bulk of your total return, if you like, or total pot at the end, is the fact that money makes money. In other words, if you invest £100 at 10%, at the end of a year, it'll be 110. The 110 reinvested grows to 121, and so on. It's compound interest, compound growth. Now, that was the first thing I suggest we do to take advantage of time. Number 2, reinvest dividends, because this basically puts the accelerator pedal down on what I just said. Now, what am I saying here? You've got equities, let's say shares. You've got equities that pay dividends. Some do, some don't. Right? The directors decide each year what proportion of profits to keep, what proportion to pay out as a dividend. As an investor receiving those dividends, you've got essentially 2 choices: spend them or reinvest them. What does reinvestment mean? It means the dividends are recycled back by your broker, your advisor, into buying more shares in the company that just paid the dividend. So you're kind of rolling up the dividend, reinvesting it, rather than taking it out and using your shares like a cash point machine. Now, how powerful could that be? For anyone thinking, does that really matter? It really does. Barclays, for example, have done a big study on the US market from 1925, and they reckon that around half of the total return since then from shares has come from those reinvested dividends, because you are accumulating more compound growth from doing so. Point 3, stay in the race. All right? Point 3 about maximizing time. You need to spend time in the market. I just quoted a study from 1925. I talked about a 25-year horizon on the first example. Time in the market is really important, and that means not suddenly taking money out of, say, a stock market backed investment, whether that's direct equities or whether it's a fund. Why? Because the moment you pull money out and put it under the pillow, if you like, it stops the clock. And that can be a disaster if it means you miss the best investing days. And why are you likely to miss them? Well, it's because what a lot of people do is they watch the market dip, they pull money out, and what they fail to realize is that the way markets and humans and crowds work is you often get some of the sharpest rises immediately after the sharpest dips. And JP Morgan have proven that statistically, looking back over previous 10-year periods and so on. So by thinking you're being cautious and pulling your money out, you're actually potentially missing some of those best investment days. And every day your money is sitting under the mattress, metaphorically speaking, it's not clocking up any compound growth. It's not paying any dividends for reinvestment and so on. So how do we avoid pulling money out of the market when we shouldn't? No panic selling. All right, markets go down as well as up. That doesn't mean you change your behavior when they go down. And no forced selling. And that's about planning. I've covered that in other videos. That's about having a rainy day fund, which is not your stock portfolio. It's about identifying those foreseeable calls on capital and funding them, perhaps using IOUs, some sort of gilt-backed product, for example. And then it's about making sure that the rest of your money can sit working hard for you, compounding with reinvested dividends, with no danger that you'll suddenly pull it out. Okay, so there we go. 3 ways to maximize time, make it your friend. To find out more, I've got some videos, killick.com/learn. You might want to go to the shares tab. There's a guide sitting next to me I mentioned earlier. It's called How to Invest in Equities. Probably can't read the cover there. Editor at killick.com for a copy of that and a few more examples, if you like, of compounding over time, a bit more on reinvested dividends and so on. And of course, our research team talk a lot about equity investment, reinvestment and so on in our quarterly magazine, Confidant. And again, that will be editor at killick.com.